What is going on, investors? Hopefully guys are doing well out there, and I know you're doing well because it is the start of earnings season over in Wall Street. Last week we covered JP Morgan. This week we're going to take a look at Bank of America. The company reported their Q3 earnings before the bell today. I am recording this during the regular trade. You'll notice this share price probably jump around. Won't mean too much. We'll look at this one from a monthly perspective when we get over to the price chart, and you'll see something that was evidence here. Maybe the last time we did a video, we are consolidating in an area. I'll talk about what that means. Now, over the last year, shares of Bank of America have not done well, down about 17.5% year to date. Basically the same story. Over the last 5 years, shares of this company just simply have not been doing well, down 2.8%. You are collecting 3.5%, but you can find a money market that's trading at, maybe giving you 5% these days. Many REITs or other investments, giving yields north of 5%. So it's not attractive necessarily from a yield perspective. You've got to have shares start to appreciate. We'll talk about if there's an opportunity here with Bank of America. Revenue coming in at $25.2 billion. That was up fractionally year over year on that revenue side. We'll go through the high level financials. We'll also talk about valuation as well as we move through these. Now, this is the most recent third quarter. So essentially your middle column is our most recent quarter. The column to the right of that is your second quarter. So that was just a quarter ago. And the far right-hand column is the third quarter of last year. So you get a year-over-year view by straddling that second quarter. Then the far left-hand columns are the most recent 9-month trend in bold, and then the previous 9-month trend as well. We're going to focus primarily quarter over quarter and year over year on this quarterly basis, considering how quickly things are changing in the banking environment and the interest rate environment. So their interest income and their revenue in general up just fractionally from a year ago, from 24.5 up to this 25, call it $25.2 billion, basically flat quarter over quarter on the revenue side. Where the company's done a decent job is controlling their non-interest expense. Went from $15.3 billion up just to $15.8 billion. That is though down from a previous quarter. So they shed off some expenses just from a quarter ago. They're squeezing out just north of about $8 billion. That's going to be your income before taxes. So your revenue hasn't moved much, but unlike some companies that we've looked at, neither have your expenses, so your net income staying relatively the same. That explains a lot of the reasons why the stock really has just done nothing over the past year. As investors, if you're not hunting for yield, you're probably hunting for some sort of growth. You could look at maybe like Nvidia's stock as the quintessential example of investors looking for growth. Now, some macro stuff, because when we look at these bank stocks, that's kind of what I'm looking at here. It's not just all about Bank of America and whether or not we're buying shares of Bank of America. It's how well the consumer is holding up. I come down here, I look at total deposits, okay? Last year, you were sitting at 1.9 trillion. You could even round that up to close to 2 trillion. Last quarter, you were just under 1.9 trillion. You're up actually a little bit quarter over quarter. Now, some of this has to do with the fact that consumers under pressure, inflation. I don't need to tell you guys, gas, everything's more expensive even as it was a year ago. But what you're also likely seeing is people taking their average checking or savings account deposit and moving it to a money market fund. Now, not every investor or not every account holder over at Bank of America is doing that, but a percentage of them are, and I know I am. Okay, I'm not leaving more than maybe $1,000 in a checking account because I can earn 5% in some kind of money market fund, and the transfer between a Schwab account or anything like that is pretty much instant. I think you should be doing that as well. If you're carrying any kind of cash in a savings or a bank account that's earning almost nothing, you should by now be transferring this over to a money market fund. It just makes a lot of sense. Now, the other thing that we look at when we look at bank stocks is our tangible book value. In the most recent period, we're valuing this company at $23.79. Currently, shares of Bank of America are trading at $27. the company is trading at a premium to tangible book value. But what I like to do is go look at the price to tangible book history of Bank of America. And we've got a 10-year price to tangible book. And look, Bank of America is trading at 1.15 tangible book, which again means it trades at just a slight premium. Tangible books at $23.79, at least at the end of the last quarter. Currently, shares are trading slightly over $27 per share. So you're trading at a slight premium. Every once in a while, Bank of America actually trades below tangible book value, which means you're paying a price below than what the tangible assets are worth in some sort of liquidation event for Bank of America. But those times are few and far between. You're probably looking at a matter of months, if not weeks, where you can snag this company below 1 time. And as you look at this chart, anytime Bank of America has gotten close to that 1 times or certainly a negative tangible book value, shares have rebounded, and that's kind of what we're looking for. Now, here's something interesting that I just want to show you. It relates a little bit to Bank of America, but also other banking sectors out there as well. Obviously, this sector has been beaten up, certainly as we've come off the beginning of the year where you had a lot of those regional banks come under a lot of pressure. Things have stabilized a little bit, but it's only stabilized because we haven't had a big need for some of these banks to sell some of their assets. So I want you to take a look at Bank of America. And this is not to alarm you about Bank of America, but this probably does apply to some other banks that might not have the $1.9 trillion worth of deposits sitting there basically earning almost no interest that Bank of America is able to monetize. Smaller banks are not going to be able to have this type of balance as that money flows into money market funds. And I'm talking about money here. I'm talking about customer deposits. If it gets pulled out rapidly in some kind of bank scare or bank run, that has obviously caused some problems this year. But also, if you just withdraw those deposits and go put it in a Schwab or Fidelity money market fund, that also can cause some problems at banks because then they need to raise funds. They need to bolster up their own balance sheet. When we look at Bank of America, these are total held to maturity debt securities. These are the debt securities that Bank of America is holding, and they're holding them to maturity. So if it's a home loan and it's got another 20 years left on its term, they're saying that they're going to hold that to maturity. But if for some reason Bank of America had to sell all of that today, they would actually realize a loss. Here's your gross unrealized losses, actually over $105 billion. And what I want you to notice, this was last quarter back in June. Here's the most recent quarter in September. Those losses for held to maturity assets actually up to about $130 billion. So again, not overly concerning for Bank of America, considering you have $1.9 trillion on deposit. Not at all a problem. And you have other assets that are actually performing. But for smaller regional banks, this is likely a similar type of thing. And what I would do is, if you're into kind of going in there and kind of picking regional banks, this is what I would be looking at, because in a distressed scenario, this number gets even bigger and it becomes even worse for a bank that needs to raise money. We're not anticipating that with Bank of America, but I did want to show you that, as that will overhang the sector for a period of time. Now, overhanging Bank of America has traded sideways really since March. We've done multiple videos about this technical pattern. You've approached this purple line. In fact, more recently, you've wicked through this purple line, which really, depending on how you've drove this line in, has rarely happened, if not ever has happened over the past decade. I love these technical patterns. We're on a monthly chart with Bank of America. Since the depths of the financial crisis, really banking stocks kind of bottomed in that 2011 timeframe. You've been making a series of higher highs confirmed by a series of higher lows. That is an uptrend. Now, the uptrend is not technically over until you really would break through these lows, but you're not far from them, okay? $22 per share. If you're dying to get into Bank of America, if you're in it already, you want to add to your position, here's what I would do. I wouldn't want to see shares break below much lower than the lows that we made earlier this month. Wouldn't want to see this one get south of $25. I'd probably have a stop loss at like $24.90 or something like that, because this trend that we're in really since November of 2021, this is still the dominant trend. High, lower high, lower high, lower lows. That's a downtrend, folks. We have not broken out of that. But it doesn't take much to get out of that trend, erase that trend, get back on the decade-long trend, and you're risking $2 to the downside on this one to maybe get halfway back into this channel. If you dissect these channels, oftentimes there's support and resistance at those levels that would take you back up to $42. So you're risking, call it $3 to $4, maybe not even that. Maybe you're probably risking close to $2 to make 13 or more. That's a pretty good risk to reward upside trade. At the same time, you're collecting 3.5%, which again, said off the top, is not really that attractive considering where money markets and some high-end quality REITs are trading. I wouldn't necessarily buy this one for the dividend. You could make an argument that you're buying it for dividend growth along with this capital appreciation, but I would have a stop loss on this one because technically we have broken the trend, or we've wicked through it. We haven't quite finished this month out. So you could argue that you're just sitting right on trend. These are the times that you would accumulate a share like this. I wouldn't make this the cornerstone of my portfolio, but certainly if I was overweight tech and overweight Cathie Wood stocks, a stock like this thrown in there is not necessarily the worst decision investors have ever made. Hopefully you guys enjoyed today's video. We'll be back again tomorrow with Netflix and Tesla. Looking forward to it, and we'll see you again soon. Good luck with your investments.